Ever wondered how to make your investments work harder for you? In the realm of personal finance, exchange-traded funds, or ETFs stand out as a formidable tool for growing your assets. Among the myriad of options, the Vanguard Growth ETF and the Vanguard S&P 500 ETF are particularly noteworthy. Each offers a unique approach to investment that caters to different financial goals and risk appetites. Stay tuned as we dive deeper into the specifics of VUG and VOO, helping you decide which might be the better option for your investment portfolio. First, let's focus on the Vanguard Growth ETF, or VUG. This particular ETF is intriguing for several reasons, beginning with its dividend yield of 0.54%. While this might seem modest, it's important to remember that growth ETFs typically reinvest earnings rather than pay them out as dividends, focusing on capital appreciation. Next, let's talk about the expense ratio. VUG has an expense ratio of 0.04%, which is relatively low and allows more of your investment to stay invested and potentially grow. This is a critical factor when considering long-term investment growth. Now, diving deeper into the performance metrics, the compound annual growth rate, or CAGR, of VUG stands at 14.66%. This rate is quite compelling, showing strong growth over time. However, with great potential returns comes greater risk. Now let's compare with the Vanguard S&P 500 ETF, known as VOO. This fund is designed to track the performance of the S&P 500 index, offering a broad exposure to 500 of the largest US companies. Starting with the basics, VOO boasts a dividend yield of 1.34%. While not the highest, it's a decent yield, especially considering the fund's very low expense ratio of 0.03%. This minimal cost makes VOO an attractive option for those looking to maximize their investment returns without being weighed down by heavy fees. Turning our attention to performance, the compound annual growth rate stands at 13.05%. This figure represents a solid return, reflecting the robust nature of the American corporate sector over the long term. When it comes to volatility, the standard deviation of VOO is 14.42%. This indicates a moderate level of risk, typical for a large-cap stock fund. In terms of annual performance fluctuations, VOO's best year saw a surge of 32.39%, whereas its worst year dipped to negative 18.19%. The maximum drawdown was recorded at negative 23.91%, highlighting the potential lows investors might face during turbulent market periods. Lastly, the Sharpe Ratio of 0.85 and Sortino Ratio of 1.35 suggest that the returns of VOO are fairly good when adjusted for risk, although not exceptional. The fund's market correlation of 1 underscores its alignment with the overall market movements. VOO offers a more steady investment path with slightly lower returns but also lower volatility compared to VUG. Having looked at both, how do VUG and VOO stack up against each other? Let's dive into the world of dividends first. VUG, the Vanguard Growth ETF, offers a dividend yield of 0.54%. On the other hand, VOO, which tracks the S&P 500, provides a slightly higher yield at 1.34%. For those relying on investment income, VOO might seem the more attractive option. Switching gears to expense ratios, both ETFs are designed to be cost-effective, but there's a slight difference. VOO boasts an exceptionally low expense ratio of 0.03%, while VUG is slightly higher at 0.04%. Though this difference might seem minimal, over the long term, even small variations can impact total returns. Now let's talk growth. VUG shines with a compound annual growth rate of 14.66% compared to VOO's 13.05%. This suggests that VUG might be the better choice for those seeking higher growth potential. Considering volatility and risk, VUG has a higher standard deviation of 16.52% compared to VOO's 14.42%. This indicates that VUG experiences wider swings in value, which might deter more risk-averse investors. Both ETFs share a Sharpe Ratio of 0.85, suggesting similar risk-adjusted returns. Choosing between VUG and VOO depends on your financial goals, risk tolerance, and investment horizon. If higher potential returns are your aim and you can stomach more volatility, VUG could be your pick. However, if you prefer a more stable investment with decent returns and slightly better income through dividends, VOO might suit you better. What if neither VUG nor VOO feels like the right fit for you? Let's explore some alternatives. First up, let's consider the Fidelity 500 Index Fund, also known by its ticker FXAI. This fund is a beacon for those who prioritize cost efficiency. With an expense ratio of just 0.015%, it stands out in the crowd. Not only does FXAI boast a lower expense ratio, but it also mirrors the returns you might expect from the Vanguard S&P 500 ETF, making it an attractive alternative for those who are cost-conscious but still looking for solid performance. Now, shifting our focus to another intriguing option, let's talk about the Schwab US Large Cap Growth ETF, or SCHG. This fund matches the Vanguard Growth ETF's expense ratio at 0.04%. However, it spices up the deal with the potential for higher returns. For investors who are growth-oriented and looking to maximize their earnings, SCHG could be a compelling choice. It aligns closely with VUG in terms of investment style, but may offer that extra zest in performance that many are seeking. Both FXAI and SCHG offer unique advantages that might suit different investment preferences, whether you're drawn to the ultra-low costs of FXAI or the robust growth potential of SCHG. Each fund presents a pathway to achieving your financial goals with a tailored approach. Remember, the right investment is the one that aligns with your financial landscape and future aspirations. To wrap up our discussion on VUG, VOO, and their alternatives, let's revisit the essential insights. Vanguard Growth ETF, or VUG, offers higher potential returns with a slightly higher risk and lower dividend yield compared to Vanguard S&P 500 ETF, known as VOO. Both ETFs show strong performance, but your choice should depend on your risk tolerance and return expectations. Considering alternatives like FXAI and SCHG can also be wise, offering either lower expenses or higher returns. Thank you for joining us. Remember, the best investment strategy is one that aligns with your financial goals and risk profile. Happy investing!